Hey, do it now. Watch a boogie sing out. Playing in a rock and roll band.
And welcome back to the show. It is 6:17 as we get the day going here on this Hump Day edition of the show. One thing that we can look at is interesting is housing. Talking about homes. I mean, we changed this attitude in America following the 2000 .com crash. Prior to that time, and prior to 2000, right? Owning a home was a function of responsibility. And we looked at it that way. And we said, you had to have a 20% down payment. You had to have a good credit score, had to have the ability to pay for the house. And of course, interest rates were substantially higher back then. I remember my first house was, I think my interest rate on my first house I bought was 10%. And that was actually cheap because it had been like 14% a couple of years before that. So I remember getting my first house and going, wow, 10% mortgage, this is great. But if you think about it, if I was going to lend, we talk about loaning money to people, right? And so you go, well, I'm going to loan money to somebody for 30 years. Think about that for just a moment. You're going to loan somebody your money for 30 years. And you're going to go, well, what kind of return do you want for that, right? So, I mean, if I'm going to loan you money for 30 years, I better get some rate of return better than I can get from somewhere else. So, if the stock market yields 6% on average, I have a choice. I can put my money in the stock market and get 6%, or I can loan my money to you over a 30-year period, right? And I should get some reasonable rate of return better than what I can get from a relative asset of the same duration. Okay, you follow me there? So, since we talk about investing money, we talk about investing money long term, right? 30 years. So you would equate that to the stock market and say, well, the average return in the stock market over the last 100 years is 6% plus dividends, but we'll just go with the 6%, make it easy. Which means that if I'm going to loan you money for your house, and I'm going to take extra risk because, Brent, he's a good guy and everything, but, he's a little shady. You're going to loan this guy money for 30 years, you would expect a rate of return higher than what you would get from a relative asset of similar duration because of the risk you're taking. So when you pay 10% for a mortgage, you go, well, that makes sense, right? I'm taking on extra risk to loan money, so I want to get paid for it. So, a 10% and 8% mortgage certainly makes a whole lot of sense over a 30-year period. But and at that point in time, house prices averaged about the rate of inflation. So every year, home prices went up about the rate of inflation. Well, beginning in 2000, we decided that we would change some dynamics in America because all of a sudden, under Alan Greenspan and George Bush at that time, everybody should own a home. We came up with these really great programs called adjustable rate mortgages. Of course, interest rates were falling. And so all of a sudden, house prices mortgage rates got a lot cheaper. The last mortgage I took out was a little bit less than 4%. That was like 3.75 was my last mortgage. Now, I want you to think about that for a moment. I borrowed money for 30 years from a bank at 3.75%. Inflation, long term, just inflation, runs right around 3% on average, give or take. So the bank has decided to loan me money for 30 years at barely the rate of inflation, barely above the rate of inflation. So in other words, their real rate of return on that mortgage is less than 1% for 30 years. Now, very few people actually live in their house for 30 years. I get that. We're just talking about math here for a moment. But when you lower interest rates, there's another byproduct of this that seems to have surprised everybody. I don't really get why it surprises everybody, but it seems to be a surprise that how could this happen? If I lower interest rates, so let's just take a very simple example and say that I'm going to buy a $100,000 house. My interest rate's 10%. So I'm going to pay over a 30-year period. I'm going to pay this house, and my interest rate is going to be built into the price of that house over a 30-year period. So, I'm paying $1,000 a month for a $100,000 house. I'm just throwing out some numbers here. Don't check my math. We're just doing off the cuff stuff. Well, if I lower that interest rate from 10% to 5%, my mortgage payment becomes a lot cheaper on a $100,000 house. So I don't buy a $100,000 house anymore. I buy a $200,000 house because I can afford the $1,000 a month, right? So now I can buy twice as much house because my interest rate is half as much. So what happened was we came up with all these, interesting ideas for adjustable rate mortgages and no money down mortgages, and surprise, home prices shot through the roof. And we had everybody and their dog going out and buying a house. And it's what the administration wanted. It's what the government wanted. They wanted everybody. Home ownership became this liberal left agenda idea that home ownership for everybody is great, but they forgot about responsibility. Homes aren't free. You got taxes, upkeep, maintenance, all this other stuff, right? But they thought it was a great idea. And then the financial community was even worse because the entire financial community started counting your house as an asset, right? It's your savings account. No, your house is not a savings account. Never was, never will be. But the end result was this massive boom in house prices. So we go through the mortgage bubble. We collapse the housing market, and here we are, just a decade later. House prices have surged back because, guess what? We're back to doing the same thing. At Fannie Mae now is a 3% down mortgage. Now, the point is that when you're buying a house, you need to have some skin in the game, because a couple of reasons is that A, when you have some substantial skin in the game, you're more likely to make sure you pay your mortgage because you don't want to lose that equity that you've built up in your house, right? If I have nothing vested in a home, I have no problem doing what they call jingle mail, which is when I can't afford it, I throw the keys in an envelope and I mail it back to the bank. And see, there you go. There's your house. Because I've got nothing in it. So I've got absolutely nothing to lose. And in this country, we've changed our mind about credit quality among individuals. We no longer care if somebody's filed bankruptcy. It used to, when I was growing up, if you filed bankruptcy, it was 10 years before anybody even look at you to loan you money again. Nowadays, if you file bankruptcy, they go, who cares? Doesn't matter anymore. Because we just package it up, sell it off to some Yahoo that'll be willing to take on that liability. So, the sanctity of credit and the sanctity of responsibility have been destroyed over the last couple of decades. Now, why do I tell you all this stuff? Because you need a little bit of background to try to understand an interesting position. Millennials are shocked, I tell you, about what's happening with home prices. We had Andrea Rickwire on our show. She's a young writer, very good, but she hasn't been around that long, so we have to give her a little bit of leeway here. But she wrote an article about housing prices, and she's shocked, I tell you, about what's happening. At the end of 2017, 27% of prospective home buyers thought their house hunt would get easier in the months ahead. But by the end of last year, that number had dropped to just 19%. Over the same period of time, the same people saying they planned to buy a home in the next 12 months fell from 24 to 13%. Now, let's go back. End of 2017. What happened in the first part of 2018? Anybody happen to remember at all? Brent, you remember what happened at the beginning of 2018? not stock market related. Yes, the stock market had a pretty good tank in February and March, but what else was going on at that point in time that would potentially impact the housing market? Interest rates went up to over 3% on the 10-year Treasury.
Weren't we rebuilding from some natural disaster?
Well,
event?
that was the other thing, right? But that doesn't really affect home prices that much. Actually, that actually lowered home prices in Houston. Was your house flooded by Hurricane Harvey? Yeah.
Too bad.
I'll pay you less. I'll pay you less for your house if you would like to sell it, since you're now in a permanent flood zone for the rest of eternity.
Your life.
And by the way, we've gone through that whole remapping now. All of these people that were not in a flood zone before are now back in a flood zone. Anyway, but no, interest rates went up to 3%. So when interest rates went up over 3%, guess what happened to people's payments? I'm out shopping for a house. I want to buy a new house, and all of a sudden, I think my payment's going to be $1,000 a month or whatever it is. That's my budget, and the price of the house goes up markedly because interest rates jumped. And not surprisingly, the demand for houses dropped quickly. Why? Because people today can't afford. See, if you're putting 20% down on a house, who cares if your interest rate moves half a point one way or the other? If you're putting 20% down on the house, it doesn't make that big of a deal. You just put down some more money because you have savings. I've never put down less than 30 or 40% down payment on a house. Never. Most of the time I've just paid cash, but I never put down less than 30 or 40% because I want to I put down enough to manage. I don't care what the rate is. I put down enough money to have the right payment, right? That I want. That's good for me. But for most people buying houses, they have no savings. They have no money. So this is why they have to have a program that's 3% down. They have to have a program that doesn't care about credit quality. And they have to have a program that has extremely low interest rates because otherwise they can't afford it. Shocker. Be right back after the break. I'm your host, Lance Roberts, the Lance Roberts Show. Don't go away.
Want a longer talk with Lance about your money? Request a personal one-on-one at lancerobertshow.com.